Hi, Ron Yarbrough here. I thought I'd put together a video. Hopefully, it's not too long, and some of you first-time home buyers that are wanting to get a little bit more information will reach out, and I can give you some more details. But I'm going to put together a real quick presentation on the 10 steps to home ownership, and hopefully you'll get something out of this. And send me some feedback and let me know what you think. I'd be happy to get into more details in future videos or less, whatever you think is better. Anyway, the 10 steps to home ownership. Number one, you want to determine if you're ready. What that can mean is a lot of things. Is your family ready? Are you ready to move out of your house? Are you ready to take on the responsibility to actually own a home and and maintain that home? To determine if you're ready is something that you need to discuss with your significant other, wife, or parents. Calculate what you can afford. So basically, you can take your gross income before any taxes are taken out, if you're W-2'd, and your net income if you're self-employed. And you're going to take that gross number and you're going to multiply that number times approximately 30%, which is considered to be not overburdened with housing expense. And you'll come up with a number that will justify what your total payment on a home would be, which would include your house payment, your taxes, your insurance, and all those things associated with the financing of the home. Then you need to save up for your down payment and closing costs. So even if you're doing a zero down home loan through VA, USDA, MHDC, other various no money down or very low money down loan programs, you still have closing costs to consider. You can get the seller to participate with some of those closing costs to ease the burden of your down payment. But I like to tell people that you need to save at least a couple $1,000 to buy a home, because you've got inspections, you've got appraisals, you've got a few other upfront fees that you could potentially get back once you close on the transaction. But there are some upfront costs associated with getting a home loan. You want to get approved or pre-approved. What a pre-approval means is you've supplied me, a loan officer, or any other bank loan officer, all of your income documentation, your asset documentation. You've had a full hard pull three merge credit report with accurate FICO scores, and that information is sent to an underwriter, and the underwriter determines that information is accurate and validated, and will issue you a pre-approval letter. At Prime Lending, we will actually give a seller guarantee that if you are pre-approved with Prime Lending and you don't close within 21 days or longer of a contract, we'll actually pay the seller for damages on that contract. Meet with your realtor after you've got your pre-approval letter. I suggest doing it after you have your pre-approval letter. Meet with your realtor. Or if you don't have a realtor, I'd be more than happy to provide you with some names of some good realtors that I work with on a regular basis. And then the house hunting begins. So you basically will put into the parameters what you can afford based upon your pre-approval letter. And then you will begin looking for homes in areas that you've already discussed with your realtor that you'd be interested in. Once you find that home, you can make that offer. Your real estate agent will typically call me to confirm what the taxes are on that property. We estimate your insurance cost on that property, and we run the numbers and issue a pre-approval letter to match the offer that you're willing to make on that property. Once you get that done, you're going to need to get inspections done on the property, and we will order a property appraisal to make sure that the value of that property is close to or exceeding the purchase price that you've offered on the property. And then we get your full loan approval. Once we have your full loan approval, you do a final walkthrough through the home, you close on your new home, and then you start moving in. So after going through the renting or through the first initial 10 steps, let's take a look at renting versus owning. So is it time for you to buy a house? When you rent, remember, that you have flexibility to move whenever you decide you want to move. You have no maintenance costs that you have to pay for because your landlord, of course, will take care of all your maintenance costs. You have less privacy, when you're renting because you're typically very close to other neighbors and you have to adhere to your landlord's rules. And your monthly payment can change. So with renting, rents every year when you renegotiate a lease, typically, they're going to want a little bit more money in rent to recapture their investment that they have in a mortgage or however they've structured their own personal equity position in their house. It's not your equity. Buying, you have the stability to build equity. So every month when you make a home mortgage payment, you're paying down on the principal of that loan. On a 30-year loan, it's not a lot of money each month, but over a year's time, it does add up. And you do gain the equity from property appreciation. If you own the house, then you're able to recapture the market value of that house as it goes up. The investment in your own home means that if you want to make any improvements to your home, add any square footage, update your kitchen, do those things, you're actually making an investment in your asset and can build even more equity as you improve that property. But you do have to pay for your own home's upkeep. If your water heater goes out, you need to replace it or hire somebody to replace it. If your roof starts leaking, you do need to get it replaced. If it's a non-insurance issue, you have to come out of pocket. So there are some downsides to owning a home because you do need to have extra money to be prepared for any type of maintenance cost or improvements that are required to keep your house in good shape. When you buy a home, you have a little bit longer commitment to that home because you have to stay in that home for a period of time to recoup your equity, to pay real estate commissions and those things when you go to sell your property to recapture your equity. I can prepare a rent versus buy scenario showing you all those scenarios. If you want, you can just reach out to me and I'd be more than happy to provide that given your specific situation. So choosing to transition from a renter to homeownership is one of the biggest financial decisions you'll ever make. And you need to decide for yourself which one is the right way for you. So renting versus owning. So renting means you don't take care of any risk in owning or maintaining a property. If something breaks or stops working, that's typically not your responsibility to fix. Renting also gives you easier moving flexibility if you need to break a lease. When it comes to your rent, that money will go to your complex or your landlord every month. You may also have unpredictable financial obligations such as application fees, deposits, pet fees. They may choose to raise your rent as time goes on. Unlike renting, when you own a home, you're responsible for all the maintenance and upkeep. And it gives you less flexibility if you need to move quickly for one reason or another. Owning a home gives you a level of freedom, space, and privacy that you may not find elsewhere. While you're paying a mortgage payment every month, you're paying something that you will own instead of something that someone else owns. Another major perk is the stability of your payments. So when you have a fixed rate mortgage, the payment on that house will remain the same for 30 years. Now, the taxes and insurance could fluctuate a little bit, but that's something you have to pay on a lease as well. You have to pay insurance, and that payment could fluctuate on top of your lease. The conclusion is this comparison is really just an overview of renting versus buying, but before you make the decision, you have to decide for yourself which one is the best way. So let's do the math. We will not just want to see how much you make each month, but we want to see a history of your income and make sure your income source is stable and reliable. For most people, this is where the downfall comes on your pre-approval, because recently you got a raise, you're getting overtime, which is not guaranteed. You may have tipped income. You may be 1099, self-employed. So all those things need to go into the initial pre-qualification and pre-approval so that we can actually come up with a good income that is deemed to be reliable and stable in order to calculate your ratios correctly. Credit seems to be the big thing for most people. A lot of consumers seem to think that a credit score is kind of like a grade. And once you have that grade at a certain level, you can buy a home. That is a small piece to the puzzle. You do need to have the ability to show underwriting that you do have the intent to pay this mortgage back. But a credit score is a prediction on how you will pay a mortgage in the future, not based upon how you have paid other people in the past or are currently. Your credit score is based upon the following information. Number one, payment history, the amount of money you owe. In other words, if you have $1,000 credit limit on a credit card and you owe $1,000, then you are pretty much maxed out on that credit line, and you may have to get more credit in order to pay your obligations. The length of time that your credit history has been established, that seems to be a bigger thing as we move forward, because a lot of consumers don't have a very long history of credit. So the longer the history and the better of that history, the higher your credit score. The types of credit that you've used. So if you look at some of these world finance, consumer high rate consumer loan companies, those types of credits typically cause lower scores because they're higher risk lenders. Also, an installment loan gives you a different weight on your credit score than a revolving loan history, which can show how well you manage your credit on a month-to-month basis. And then also on the pursuit of new credit, you've heard pulling your credit can affect your credit scores. If you have multiple inquiries from several different types of lenders, auto lenders, credit card lenders, mortgage lenders, finance company lenders, all those creditors pulling your credit, it shows that you're having a difficult time getting a credit established, and it could lower your credit score because you've had excessive inquiries. A credit report contains information about your credit, such as the status of all your credit accounts and your payment history. Lenders use these reports to decide if they'll loan you money and at what interest rate. So the lower the credit score, typically the higher the risk and the higher the interest rate. So it's very important for you to get on a plan to get your credit score in line so that we can fit the mortgage in your budget when you turn around to purchase a home. Saving money. So if I was to make a recommendation to most all younger consumers today, I would say you want to have at least 2 to 3 months of your salary in the bank before you go to pursue a mortgage, whether that be a no money down mortgage or a low down payment mortgage. If you try to get 3 months of salary, in other words, if you make $6,000 a month and you had $9,000 somewhere accessible to you in a non-retirement account, your chances of success as a homeowner is significantly higher than those who buy a home and use every last dime that they have in the bank in order to close on that loan. So it's a great idea for you to start saving, whether that be on a 6-month plan or on a 12-month plan. But you can start putting away a couple $100 a month or $300 a month. If you're looking to do a $1,500 a month house payment and your current rent is $1,000 a month, try putting $500 a month in the bank for 6 months. That'll give you $6,000. So it's a good idea for you to start saving some money now before you actually get into a contract and own a home, because you may need that home, as we refer back to the very beginning, when you have to maintain that home and have to pay for any repairs or maintenance on that home. You've heard about the 20% rule, but that's not true at all, because we do have a lot of no money down or low money down options for consumers. And in today's real estate market, where there's a limited supply of homes, there's not really too big of an issue for you to be underwater in your home when you buy it, even with a low down payment mortgage, because the supply is going to take several years, if not decades, to start catching up with the current demand of new household formations in this country. So, what are the different types of loans that you're looking for? You've got FHA, which is the government-backed loan. VA and USDA are all government-backed loans, and they're securitized in funds called Ginnie Mae pool of funds. They're all backed by the U.S. government completely at 100%. And the different programs will allow for different payment options and different risk levels for you. Me as a mortgage banker, I want to figure out exactly which is the best program for you financially over the next year, 5 years, or 10 years, depending on what your financial goals are for you and your family. There are home ready, home possible conventional options available, which are limited 3% down payment. Hopefully there'll be some new down payment options available as well coming forward to help with home ownership. Qualification versus approval. So I hinted around to it in the very beginning. I have a lot of consumers that will call me and they'll say, hey, I need to get a pre-approval. Can you help me? A realtor will send them to me and say, hey, they need to get a pre-approval. Can you get that done in 10 minutes? The answer is yes, I can get a pre-qualification done in 10 minutes. And then we need to go through the process of validating that information so that we can actually help make a decision that is going to last through a contract and closing. So a qualification is basically you filling out an application, whether it be over the phone or through the internet, putting in your employment information, putting in your asset information, running credit, and validating that or looking at that information to determine whether or not you would be approved for a home loan if we could verify your income and verify those bank statements going forward. So basically a pre-qualification is an approval only based upon your credit and the information that you've put into the system, and then we have to validate that information. A pre-approval is the same thing, except we've actually got your last 2 years income information, your current bank statements, your pay stubs, any other additional information that's required by your current situation. And we've sent that information to underwriting to have an underwriter look at it and approve it based upon all the information that's been put into the computer. So do you need to fill out a mortgage application? On a qualification? No. On an approval? Yes. Do you have to pay an application fee on a qualification? No. With prime lending on an approval? No. Does it require a credit history check on a qualification? No. I can do what's called a soft credit pull in order to get a credit score and to look at your basic credit history. But on an approval, yes, we do have to pull your actual credit. Is it based upon a review of your finances? Yeah, no. On a qualification, we're not actually reviewing your finances. On an approval, yes. Does it require an estimate of my down payment? On a qualification, no. I can put in that you're going to have 3.5% from a down payment gift. But then when we go to validate it on the approval, we have to verify that gift. Will the lender give you an estimate for the loan amount? Yes, I will. On a pre-qualification, I can give you an estimate based upon the information that we have. On an approval, I'm not going to give you an estimate on the loan amount. I'm going to give you an actual loan amount. Will the lender give me a specific loan amount? Not on a qualification. I'm not going to do that. I'm going to give you a good idea of where you can be buying at. But on an approval, yes, you'll have an exact number of what you're qualified for. And will the lender give me an interest rate information? On a pre-qualification, I'm using it as a guess, basically guessing what your interest rate would be based upon that criteria. there's actually 38 different data points that I need to validate in order to get a valid credit score. So what are your options on a on home loan, on the different types of home loans? So in 30 years of helping homeowners get a mortgage, first-time home owners, every single loan that I've helped somebody with is unique in itself. There's millions of different ways to put things together to financially benefit somebody. So every home buyer is different. That's why we offer at Prime Lending numerous home loan programs that fit various budgets and situations. We've got conventional FHA, fixed rate, adjustable rate, interest only. In addition to that, we've got bond rates and all types of different ways to put it together. So first step, step number 5, I guess, is, set a meeting. So once we've got everything put together and defined the mortgage that best suits you, you need to set a meeting with your real estate agent. You definitely want to include your lender in that conversation, so the real estate agent will understand what your pre-approval is for, what type of loan, what type of property, so that everybody's on the same page when you get ready to go to the next step. So you need to get with your real estate agent. Your agent will look out for your best interest in finding homes that meet your criteria, get you the showings, help you write up the offers, negotiate things such as inspections, negotiate the purchase price, negotiate any seller paid concessions. And typically in today's market, a lot of times the listing agent will compensate the buyer's agent, so you don't, as a buyer, have to pay for those fees directly. The commission's typically around 3% of the purchase price for the buyer's agent to help you, and is paid by the listing agent, listing broker. The real estate agent can represent you and understands how to buy a house. They do this for a living. There's a lot of details involved in every single piece of a transaction. So let them take care of all those details. So all you have to take care of is just getting your financing put in place and getting ready to move and move into your new home. If it's possible to buy a house without a real estate agent, it is possible. However, I'd strongly recommend that you don't. A lot of people want to buy a for sale by owner, and a lot of times that is very problematic, especially when there's any kind of things involved in the transaction that go sideways, such as an inspection issue or whatever, and you don't really have any fiduciary responsibility to any agent in the transaction to go to bat on your behalf. We do them all the time, and I'm more than happy to help you out with them, but I highly discourage you from going that direction. So house hunting. So in today's technology, there's all kinds of ways to put you into automated searches and put in your specific criteria where you're looking for a home, price range, square footage, home condition, possible need for repairs, if you need to have access to public transportation, number of bedrooms, do you want a backyard, are you looking for a swimming pool, is there one at the house, is there one close to the house, local entertainment options, school district information. All that information is available now through public sources, and your agent can help direct you in the right direction to get those details. Rank your priorities from the most important to the least important, and then show this list to your agent. That way they can help narrow down those searches, save you time and save them time in looking at houses that you would actually be interested in. Once you find your home, then you're going to be needing to make an offer. Your agent will sit down with you and decide how to help you make that offer. Are you going to offer X dollars and have the seller pay your closing costs? Are you going to strengthen your offer by not having the seller pay any closing cost? Are you going to do an FHA loan versus a conventional loan? How well qualified are you? Are you going to have, you can always call the lender, such as myself, to help aid in that contract or offer situation, because I'm more than happy to reach out to a seller's agent to let them know the strength of the offer and the strength of your financing. The seller can also come back with a counter offer of their own, saying, you know, if you could just help me out $1,000, $2,000, you know, we can make this contract work. And then you start to go down the path of home ownership. They may need to change the purchase price, the terms of the sale, when you close. Everything in a contract is a negotiated item. After you get the contract accepted, you'll need to get an independent third-party appraisal, or inspection. And that inspection will let you know every little detail that's wrong with that house. I like to call it the honey-do list, because it's a long list. And a lot of those things are really trivial, but that does look out for some major repairs that may have not been noticed by the seller or may have been uncovered during the inspection period. It's money well spent, so we highly encourage you to get a whole house inspection, regardless of what type of loan you are doing. The lender, once those inspections are negotiated and the house is accepted as is, then we would order an appraisal. The appraiser goes out to make sure that the house is worth on the market what you're willing to pay for it. And then if it happens to come in a little bit under appraisal, you'll have the opportunity to renegotiate that contract to either lower the sales price or increase the amount of money you want to bring to close in order to finish purchasing that house. So once that's done, you know, you're cleared to close. You go to the title company, you sign some documents and whatnot to close and own your home. Right before that happens, you're going to want to do a final walkthrough. You want to make sure that house is, if there was any repairs that need to be made, that those were made. You want to make sure that the sellers left it in decent repair condition for you when they moved out. You just want to look for any major issues that may have popped up during this transaction that you would find to be unacceptable for you to actually sign all your closing documents, because once you sign all those documents, the house is yours. You can't back out of it at that time. Then you're done. Welcome home. We send you an email, gives you the exact amount of money that you need to have at closing with a cashier's check or bank wire. And you sign some documents via email, and then you sign some documents in person that will be notarized by a witness. And then you are a happy homeowner. And I'm hoping to keep track of your loan going forward from that point to make sure you're always in the best loan product. Should there be any additional questions that pop up in your future, you're welcome to call me and we can discuss those. If you need any documentation that we may have collected, I'm happy to help you with those as well. We're here to help you. We want to be your lifelong lender. So feel free to reach out anytime with any kind of questions whatsoever. Look forward to speaking with you. And if you'd like to get some more information specific to this presentation or to your scenario, please reach out. I'm more than happy to help you in any way I can. Thanks. Bye.